So we think there's three key reasons why the RBA will start easing later. Firstly, the inflation cycle has lagged in Australia compared with other countries. The RBA has been a bit of an outlier in central banks in having a more balanced trade-off between bringing inflation back down to target, but also trying to avoid unnecessary damage to the labour market. And I don't think we're going to see a shift in that trade-off. The second reason is that the wages cycle also lags in Australia. We have quite a rigid pay setting regime in Australia compared with some other countries. About 50% of employees are on enterprise bargaining agreements or award wages. Awards are reviewed once a year. EBAs can be locked in for 2, 3, 4 years. So that means that wage growth was slower to pick up in Australia. We're only just peaking now, whereas other countries are generally quite a bit past their peak. And it also means we'll be slower to see wages growth ease as well, particularly as there'll still be a lot of workers on EBAs who will still be rolling onto agreements with higher wage increases over coming quarters. The third reason is also tax cuts coming up. So we've estimated that in that first year, 24-25, they'll be equivalent to around 2 25 basis point rate cuts. We're expecting only a shallow easing cycle in Australia, moving back towards neutral rather than actually having to stimulate. But if we think about household balance sheets, yes, they have improved. If you look at some of the headline measures that suggest that households are more sensitive to rates now, more exposed. But when you take into account especially some of the measures that include assets, including liquid assets, we're actually not that much more exposed. And I think there's evidence for that in that households were not as sensitive to rates as most people, I think, were expecting. The cash rate had to rise quite a bit more to become restrictive than what was expected, which I think just reflects that resilience because of that strength in the balance sheet. On the flip side, though, there's an argument that excess savings contributed to this reduction we saw in the neutral rate over the past couple of decades. Because if you're building up savings, but those savings aren't being funneled towards real productivity enhancing investments, then you're going to have lower potential growth than you would otherwise, which all else equal means a lower neutral rate. So there's a two-way pressure there.